far as we've gone over some of this? Is it making sense? What I want to just preface regarding this chapter, we're mainly going to, you'll have questions on what's the difference between the initial value and the partial, but any problems we really, not that you're going to have a problem like this, but it will always relate to the equity method. So basically what I want to do is now look at exercise 16. Haynes obtained 100% of Turner Company's common stock on January 1st, 2014 by issuing 9,000 shares of $10 par value common stock. Haynes shares had a $15 per share fair value. On that date, Turner reported a net book value of $100,000. However, its equipment with a 5-year remaining life was undervalued by $5,000 in the company's records. Turner had developed a customer list with an assessed value of $30,000, although no value had been recorded on the books. The customer list had an estimated remaining useful life of 10 years. The following figures are from the accounting records of these two companies. So we show, as of December 31st of 2014, the revenues of Haynes, the revenues of Turner, the expenses, and then the dividends that have been declared. The following figures come from the individual accounting records of these two companies as of the next year, December 31st, 2015. Gives us our revenues, our expenses, the dividends declared, and equipment for 2015. Now the first question it asks us is, what balance does Haynes' investment in Turner show on December 31st, 2015 when the equity method is applied? So we're going to calculate the investment Haynes has in Turner as of 2015. I'm going to do it very similar to how we did the previous problem. So we start by the consideration given, or the fair value of Turner. It showed 9,000 shares at $15 a share was the consideration that was paid. So we'll show, let me clean this up. We'll start by showing the fair value acquisition was $135,000. It told us the book value was $100,000. So we're going to show book value of subsidiary of $100,000. The excess of $35,000 is what we have remaining. Now we know that we had equipment that was undervalued by $5,000, and we've got a customer list for the difference of $30,000. The equipment has a useful life for 5 years, and the customer list has a useful life for 10 years. So here is the allocation of the excess. This is going to be equipment, and this is 5-year amortization or depreciation. and the customer list is a 10-year amortization. So each year this will be 1,000 and this one will be 3,000. So amortization will be taken of 4,000 each year on that excess. So the way we're going to determine the investment in subsidiary, we're going to start with the fair value acquisition of 135. Then we're going to show the income that was accrued in 2014. So the income that was accrued is the 230. The expenses were 120 with an income accrual of 110,000. So the income of Turner, or excuse me, subsidiary, 110. Then the dividends that were declared by Turner were 50,000. So we need to dividends declared minus the 50. Then the amortization for 2014 will be minus $4,000. And I believe they want to know what balance does it show on 2015. So we're going to need to do this again, all this information for 2015. So the income, again, income of subsidiary, this is 2014, dividends for 2014. Now income of subsidiary for 2015 shows that we've got 280 in revenues, 150 in expenses. So that would be a $130,000 income accrual. The dividends declared were 40. So we're going to show the income of 130, the dividends declared in 2015 were 40, and the amortization in 2015 will be 4,000. So we should show the balance in the investment in sub as of 2015 would be 277,000. So we're basically taking the consideration, adding the income, subtracting the dividends, and recording the amortization to show our investment. The next question asks, what is the consolidated net income for the year ending 2015? So we're going to take both companies. So we see in Haynes, they started with 600 of revenues, expenses of 440. That shows net income of 240. The net income of Turner here, 230 minus the 120, is 110. Wait a minute, for 2015, not 2014. Let me make sure I'm saying it right. For 2015, okay. So we show the revenues from Haynes of 700. The expenses are 460 to give us net income here of 240. The income of Turner is $280 minus the expenses of $150, give us a net income of $130. Then we need to show the amortization expense along with the depreciation expense to come up with our consolidated net income. So we'll have here the net income of the parent is $240. Net income of sub, $130. Depreciation on equipment, $1,000. Amortization, $3,000. So our consolidated net income is going to show $366,000. Remember, the one piece we're going to just take the income from both, but we need to make sure we take into account the excess amortization we need to include in that.
Question.
Yes.
Go back to the spreadsheet.
You bet.
How come you separated the depreciation and equipment and then said amortization even though?
Because we've done it the other. You know what? Let's not do that because that confuses everybody. Let's just keep it the same way. Minus $4,000 here. You'll see in this next example why I started separating it, but let's not do it yet. We'll look at this next part. So I'm going to keep it the amortization there, okay? Let's look at C. What is the consolidated equipment balance as of December 31st, 2015? How would this answer be affected by the investment method applied by the parent? So the equipment balance as of 2015, we show equipment on Haynes is $500. Equipment on Turner, we show $300,000. Then what we'll need to do, let me just go into my Excel. So, equipment balances. We show parent equipment $500,000. Sub equipment $300,000. But we remember when we acquired it, we had an additional $5,000 that was the fair value of their equipment over their book value. We'll need to now show that the allocation on the equipment fair value needs to add $5,000 there. Then we need to show what we've taken in depreciation on the equipment in 2014 and 2015. If we go up here, we took $1,000 each year. For 2014, we took $1,000 against this equipment and $1,000 in 2015. So we'll need to show that accumulated depreciation for the $2,000 to come up with the consolidated equipment as of 12/31/2015 will show the $803,000. So based on this problem we were getting ready to do, I was starting to change the thinking, but you see why that amortization does have $1,000 each year in equipment. So truly this will affect our consolidated equipment accounts to come up